Hi everybody, my name is Hachin Singh. Thank you for joining us for episode 2 of the 3-Tier Investing Podcast. So today's topic is all about credit scores. So first, understanding what they're made of, and secondly, how you can improve that score so that you can get better interest rates so that you're paying less long term, you're more reliable, and it just makes life a whole lot easier. So let's get right into it. The first thing that you're going to hear about is the FICO Score. So you're probably wondering what that stands for, and it's not something that you're ever going to want to know, like geometry, right? So it stands for the Fair Isaac Corp. So basically, they were a data analytics company that helped rate what type of borrower you were. So what was happening a lot of times, because this company was founded in 1956, right? People would borrow money from a company to buy a TV, they'd finance, then they wouldn't pay it back. And the company would be out. They'd be like, shit, this guy's not paying me back. Then they'd go to a different place, borrow money for a couch, and then they wouldn't pay that back. And so, there was no way to see, can I trust this person to borrow some of my money? So FICO, this company, basically created this number, this way to evaluate what type of borrower you were. And thanks to them, it's something that we all got to worry about every single day. So thanks, Isaac. Thanks. So let's get into some of the details, right? So that score is basically from a range of about 350 to 850. And the way that score is weighted is in a couple different categories, about 5, right? So you got your payment history, your amount owed, how long or how much of a history you have with credit, any new credit, and the type of credit you use. So these are weighted differently too. So your payment history, how accurate are you with your payments? Are you paying on time? That's about 35% of your score. So if you miss a payment, that can drop your score heavily, like 50 points or 100 points. That's something that you have to be on top of. And if you're forgetful, you can set up auto pay. There are a ton of tools nowadays to help you out with something like that. Set a reminder, auto pay, whatever you need to do. But make sure you don't miss a payment, because that can heavily impact your score in the exact opposite way that you want it to. So then the second category is the amount owed. So that's about 30%. So it's really ironic that it's 30%, because the analysts say that you should use about 30% of the amount that you have available. So let me put that into perspective. Let's say I've got 2 credit cards, right? On one, I can borrow $2,000. On the other credit card, I can borrow about $3,000. What that means is that my total revolving credit just means this is the total I have available to me every month if I paid in full, right? I pay off all my debt, I have this X amount available to me. So for the sake of argument, let's say that I have $5,000 available. Credit card A, my Visa, has $2,000, and my American Express has $3,000. So I have $5,000 for myself. So if I want to do 30% of that, then that means that I can only use about $1,500 a month for me to keep that below my 30% range. Keep that in mind, because if you're going to be using more than that, that could impact your score negatively. So maybe you want to think about long-term getting a raise in that, or finding a way to balance out those credit card payments that you're going to be making. And then the next category is the length of your credit history. So what that really means is that if you've had a card for 7 years, right? You opened it when you were 18 and now you don't use it. It could actually hurt you to close that card because you've had it for so long. So that one card is kind of carrying your whole length of credit history. So it shows somebody who's reliable, somebody who is loyal to that card, if you want to put in those terms. But they like to see somebody holding a card for a long time. That helps them, kind of factor you into somebody who's not a risk. And the next category is going to be new credit. So what that means is, going back to this whole idea of opening new credit cards, if you keep opening 1 or 2 or 3 credit cards every single year, that can impact your credit history negatively, because it shows that you're just opening more and more and more cards. Then they start to wonder, okay, why is this person opening so many cards? Why do they need so much money? Are they paying off the card in time? And while it may be good to have more revolving credit, going back to this whole point of amount you owed, if you end up raising your credit limit to $10,000, then you basically have $3,000 that you can use every month. And while that's beneficial, it can be negative to keep opening up cards. You have to be really careful, because every single step you make is it's like stepping on glass. You got to be very careful. And the last category is going to be the type of credit that you have on your account. So to discuss that, basically, you need to know that there's two types of debt, right? There's good debt and then there's bad debt. Good debt would be something like a mortgage. You've got a house, you're paying it back, but in the process, you're getting equity. Bad debt is something like credit card debt, right? You bought something, there's not really any return to it, so you just got to pay it back. You're not getting any value by paying it back other than having a better credit score when you really think about it. So based on that, if you've got like a car loan or a personal loans are a little bit riskier, right? Because they're not asking what you're using it for. A car loan, they know it's going towards a vehicle. Everybody basically needs transportation. A home, everybody needs a place to live. Those are basic essentials that are expensive, but every person needs one. So if you're borrowing money, it's for a good reason. If you're taking a personal loan, let's say you gambled your money away, right? Just for example. Now you got to pay your credit card, so you take a personal loan, so you're consolidating. Now you're borrowing from 3 different places. That can negatively affect your account if you're doing that too often. So knowing that all of these categories affect your score, now we got to think about how we can improve our scores. So if we want to lower our credit usage, you have the ability to open a new card. Now, one of the ways that people do this, if you have no credit, is by opening a secured credit card. Now, what that means is that you put money up front. Let's say I want a secured credit card for $500. So I would pay the company $500, and then they'd give me a credit balance of $500. So let's say I'm borrowing money, right? I use my credit card, I spend $300, and then I realize, oops, I don't have money in my account, I can't pay it back. What that means is you're borrowing from yourself at that point. Now, if you default on that, it's you not paying yourself, in a sense, right? And what that does is it gives you an opportunity to build your credit while not really being at risk. Whereas if I was borrowing from Visa or American Express, now I'm in a situation where if I can't pay them back, that's their money. Now they're going to be real careful about lending me money if I don't pay it back. And the way they're going to do that is by wrecking my credit score in the process. So if I want to build that credit score, secured credit cards are great. Additionally, if you have somebody in the family that would love to co-sign you, if you've got a parent or you've got an older sibling, what they can do is they can actually add you to their credit card. And as you keep spending with their card, even though they're responsible for the bill, what that does is it shows these lenders that you're responsible enough for that, sponsor, right? We're going to call them sponsors because they're the ones holding the card in their own name. Shows that if they think you're responsible enough, so are you. So you kind of get that benefit of having your credit score affected because of them and just having your name on their card. And the last way is going to be kind of obvious, but it's as simple as just paying your bills on time. And that comes with good management of knowing when your card bill is due and etc. So if you pay your bill every single month, that's like 35% of your score, right? So you can count on just paying that much to make sure that your score continues for its, maintenance. And another way to look at it is this. If you sign up for a card that has 0% APR, let's say you're a college student, you got to pay tuition. A really cool idea would be to get a 0% APR card for like 15 months. I know Chase has one. You pay your tuition with that card. Now you've got 15 months, no interest, to pay it as long as you're basically taking care of the bare minimum, or you find a way to basically divide that up into 15 equal payments, Then you think about it like this. Now you've got a card, you're paying it every month, and you're taking care of your tuition. However, that may make sense, right? But then you think about it like this. If your credit utilization on that card is $5,000 and you max it out, that means that you've basically put 100% on that specific card. Now that usage plays a very, very big part. That usage is 30% of your score. So you got to look at all the aspects. Now it could be beneficial to do that with your tuition, but you got to look at the bigger picture. So those are just some tips on how you can improve your credit score. As always, if I've made a mistake, please feel free to reach out. Ultimately, the goal is to educate and the goal is to learn ourselves. So if we do make a mistake, I humbly do apologize, but hopefully there was something from today's podcast that you could take home and learn from. So at the very least, use this podcast as something to engage with, to learn from, so that maybe tomorrow you can start working on your credit score so that next year you're at a point where your rates for borrowing are lower because your credit score is higher. And what that means is long term, you're going to pay less, you're going to get more, and you're going to feel proud. I mean, if we had to wear our credit score on our shirts every single day, would it be something that you're proud of? I know it's something small, it's just a credit score, but genuinely, without being dramatic, it could change your life. So keep that in mind. With that being said, thank you for your time today. I appreciate you. Continue working towards financial freedom. If you have any questions, feel free to reach out at 3Tier Investing on Instagram. I look forward to hearing from y'all. Thank you. Have a blessed day. Peace.